Hi everybody, this is the big one here, a brilliant video for your macroeconomics exams this year. We're looking at UK economy stats for 2022. Your job, guys, is to take down everything from this video and make sure you sprinkle these stats in your essays, in your macro exams. It's going to push you up to a very high level. But do me a favor as well, guys, please share this video with everybody you think is going to be helped by it. Anyone that's going to find it interesting, share it so that we can help as many people out as possible. Also, bear in mind, guys, that this video is in my revision for 2022 exams playlist, a playlist with so many videos geared towards helping you smash those final exams. So yeah, we have this one in the playlist, but many more that are going to be great for you to watch. Make sure you're watching those in that playlist as well. So let's get into it, guys, starting with economic growth. Well, our annual growth rate is 7.4%. That is our growth rate throughout 2021. This figure looks very high, but bear in mind it's coming from a low base. The year before, 2020, the UK economy shrunk by 10%. That was a huge contraction of GDP. In truth, our worst recession in the UK for 300 years. So yes, this figure does look tremendously high, but it's coming from a very low base of GDP. In truth, that was a pretty good effort for 2021. It beat estimates of what we thought growth was going to be in 2021. So very good there. Our quarterly growth rate, this figure is a little bit out of date. It's going to be updated on the 12th of May, but all we have, the most recent figure, is quarterly growth from Q4 in 2021 at 1.3%. But more interesting is what we're expecting growth to be this year and next year. Our annual growth forecast for 2022 is only 3.8%. So you can see nothing like the growth we got last year. In truth, this is far below what we thought growth would be this year. Just a few months back, forecast was saying just over 6% growth we can expect in the UK this year. Now all the way down to 3.8%. The cost push inflation that we're seeing is biting in the economy for sure, and that's driving down our growth estimates. In truth, there are some commentators out there saying by September, by October, the UK could be in another recession. So recessionary forecasts I'm hearing, stagflationary forecasts I'm hearing. So there are many variables at play that could change this figure. So even though 3.8% a bit disappointing, it's still positive. That could change as the months go on this year. Next year, we're expecting 1.8% growth, but again, many variables that could change these figures. Our output cap, this is an OBR estimate at plus 0.7%. That is a positive output gap situation in the UK. To get this figure, we look at our actual GDP compared to our potential level of GDP, and we are greater than our potential GDP at the moment. Not hugely surprising that it's a positive output gap. We are seeing strongish recovery. Unemployment is below the natural rate. Our natural rate is around 4% unemployment, and we're at 3.8% unemployment at the moment. And we are seeing demand pull inflation too. That's normally a sign that we're in a positive output gap territory. So good to know that. Our GDP per capita, that is income per head, is £31,400. And our total GDP, £2.4 trillion, is the estimate. But I think great to know the breakdown. And you can see just how unbalanced the UK economy is. 79% of our GDP comes from the services sector. Now, on the one hand, that's actually a good thing because services like financial services, banking services, legal services, education services is what makes the UK economy very large, very rich. But the downside of this kind of unbalanced growth is that if there is a shock in the services sector, like we saw during the financial crisis years, like we saw during COVID years, where hospitality, tourism industries, leisure industries, all these big services industries took a massive hit, it could drive the economy into a very, very deep recession without other avenues of growth to keep GDP up. So there are upsides to this, but major downsides. We have a very unbalanced economy in the UK, that is for sure. We can see manufacturing only 14% of GDP, construction 6%, agriculture only 1%. It partly explains why we had a 10% contraction of our economy in 2020, which was a very poor economic performance during COVID years. Now let's talk about unemployment, shall we? Our unemployment rate is remarkably low at 3.8%. Our natural rate of unemployment is somewhere around the 4% mark. So we are under that, hence the positive output gap estimate the OBR is saying. What's helped to keep that figure very low, even during COVID years, was a lot of government policy to prevent unemployment spiking. Even during the worst part of the COVID crisis, the highest unemployment got to was around the 5.4% mark. So we can see that unemployment hasn't really been a massive concern in the UK. Furlough schemes, the wage subsidy scheme, where the government was literally paying wages of the employed and the self-employed, really helped to keep that figure down, as well as other policy measures helping businesses out with grants and stuff, allowing businesses to retain staff without sacking staff and making that unemployment rate rise. So this is a remarkably good performance, a remarkably low figure in the UK, a positive sign and a sign of how tight the labour market is. However, there is a caveat to this, and that's the next two figures. Our employment rate, that is those of a working age who have a job, is 75.5%. Now pre-COVID, that figure was 80%. So even though unemployment has recovered, that rate has come down back to pre-COVID levels, the employment rate hasn't gone back anywhere near the 80% mark. And that can be partly explained by figure number 3, the economic inactivity rate. That is those of a working age who are either not willing to work, not able to work, or not seeking work. That figure is 21.4%. That is higher than pre-COVID levels, more than something like 1.5% higher than pre-COVID levels. So what that's telling us is, if we're seeing lower unemployment but employment is not rising, it means more and more people that were in work prior to COVID are not returning to the workforce. They're not willing to work anymore. So they're not going to be counted as unemployed, hence the unemployment rate looks low, but the employment rate doesn't rise at the same time. The inactivity rate goes up. And these are workers in their 50s, workers in their 60s who were in work prior to COVID, maybe lost their job or were furloughed during the COVID period and have reassessed their life priorities and have not returned back to the workforce. So not going to be counted as unemployed, but obviously not going to be part of the employed either. It kind of explains a bit of the mystery there, why that figure is so low, but the employment rate hasn't risen. So those kind of workers, yeah, maybe taking early retirement, reassessing what's important to them in their life post-COVID. That figure has increased the inactivity rate, which is why the unemployment rate looks so good, but there are still so many job vacancies in the economy and labour shortages in the UK. Youth unemployment has come back down. This peaked at 14.5% during the COVID years, now down to 11%, just like it was pre-COVID. Not surprising that this figure went up. It's normally youngsters that lose their jobs the quickest in a deep recession because they're low skilled in terms of work skills. They don't have much work experience. So firms tend to let them go the quickest, and they're also very easy to re-employ. And as we've seen recovery in tourism, in leisure, in hospitality, industries that tend to hire a lot of young workers, we've seen that rate come back down again to around the 11% mark. Long-term unemployment, this was never a concern in the UK over the last few years. Again, a lot of the government schemes in place prevented this from rising dramatically. Long-term unemployed is unemployment lasting more than 1 year, and it stayed at around 1% even during COVID years. Wage growth is quite high in the UK, a very tight labour market, and low unemployment is helping to drive that figure up at 5.4%. In truth, it's been quite high for a year or so, but inflation in the UK right now is 7%. So we can see that real wage growth is actually negative, not keeping up with the cost of living in the UK at the moment. Job vacancies, record high in the UK. There are labour shortages across so many industries right now in the UK. Another sign of just how tight the labour market is. Firms really struggling to employ workers and fill jobs gaps that there are in the economy. That is helping to drive wage growth and will continue to drive wage growth going forward. Consumer confidence is a very interesting one. It has been super high. As unemployment has come down, COVID restrictions have been easing. Generally, consumer confidence has been rising. We've seen that with huge consumer spending. In 2021, 90% of aggregate demand was consumption. Consumption has been driving our recovery. High consumer confidence has played a large part in that, but recently it has fallen off a cliff edge. Not surprising. We're in a cost of living crisis at the moment. Inflation spiking. People very concerned about their financial situation. Just recently, retail sales figures were very disappointing, a sign that consumers out there are prioritizing their spending. They're making sure they're spending on essentials, whether it's fuel bills, gas bills, electricity, food. They're prioritizing that necessity spending over luxury spending. So that consumer confidence sharply falling is starting to feed through into lower than desirable consumption data as well. So very interesting stuff. Let's continue by looking at inflation next. Before we get into inflation, I wanted to mention my Examples for Exams pack. This book gives detailed examples for everything in the economics course, micro and macro. Now, it's all good to have stats like these and to use them in your macro assessments, but actually what you guys need is knowledge of detailed examples, holistic use of examples that you can use in any essay that will come in your final exams. And that's exactly what this book gives you, both micro and macro. So in macro, detailed examples of case studies that you can use. In macro, yes, there are stats like this, but also detailed case studies of countries and background behind the examples, detail behind the examples. That's going to be very helpful when you're writing essays. So if you're interested, you can get this through my website, EconplusDal.com. There is still plenty of time left for you to get this and to use it well in your final exams. If you're interested, on my website, you can also see sample pages of exactly what the book is like, and then you can get it from there if you want to. But without further ado, guys, let's get into inflation and understand what's going on there. Well, inflation is the really scary indicator at the moment. We can see CPI inflation rate in the UK 7%. That's miles beyond our 2% inflation target. But forecasters, the Bank of England, have come out and said, no, we expect the peak still to come at around 8.4% by September, October or so this year. But even then, inflation is going to be stubborn and staying way beyond target until at least 2024. So persistent, stubborn, high rates of inflation expected in the UK economy. But it's not unique to the UK. In the Eurozone at the moment, inflation 7.4%. In the US, 8.5%. They've had very high rates of inflation for more than a year now. So there are a lot of global drivers that are causing inflation around the world, in the developed world, to be very high. That is for sure. Just bear in mind, guys, that this figure will be changing as you come to your macro assessments. So make sure with all of these stats, if there are subtle changes, you're staying on top of that. If we think, where is inflation coming from? Well, all the theories that you guys learn in the classroom about where inflation comes from are proving true at the moment. We are seeing demand pull inflation. We know there is a positive output gap in the UK. All of these huge expansionary demand side policies we saw during COVID times are now starting to feed through to higher inflation. The huge fiscal stimulus that we saw, the massive expansionary monetary policy, big cuts in interest rates, big QE, is feeding through to inflation. But also on the cost push side, big increases in raw materials, oil prices, very high. Gas prices have gone berserk, haven't they? There is a gas price crisis going on at the moment, feeding through to high rates of inflation. Timber prices are high, metal prices are high, food prices are rising. So all of these raw materials going up in price is driving inflation too. Wages are rising, aren't they as well? We know that wage growth is high. We know that there is a tight labor market. That's feeding through to higher inflation as well. And monetarists are right to say that a big increase in the money supply via QE will feed through to inflation as well. There is an element of truth in that too. So it's coming from everywhere, really. We're expecting it to continue because this cost push pressure is not going to go away. In fact, food prices rising is going to be the next big thing that keeps inflation high. It is very scary. Core inflation is a very interesting figure. This is the CPI inflation rate, but taking out price volatile items from the basket. Take out food, fuel, gas, and electricity, and you're left with the core inflation rate. And what this tells us is the underlying inflation rate, the general rise in prices of consumer goods and services across the economy. So if ever we feel like food prices, gas, electricity, fuel prices are driving the inflation rate, they're distorting this CPI inflation rate, we can always go to the core inflation rate, which strips those out. And if there is a difference, a big one between the two, we know it's one or more of those four different goods that's kind of driving the rate of inflation. At the moment, you can see that core inflation is slightly below CPI. So we know it is fuel, it is gas, electricity, food that is driving the very high rates of inflation. But core inflation is not far behind. So generally, prices of all consumer goods and services are rising far beyond target. It is a concern, inflation at the moment. Producer price inflation looks at the change in price of a basket of goods as they leave the factory gate. This is wholesale inflation, the price of goods as they are manufactured, the changes in the price of those goods as they're manufactured. This is one step before the CPI inflation rate. If this rate is very high, it means input costs are rising for firms. Their cost of production are rising, like their raw material costs, like their labor costs. And if this figure is higher than the CPI, like it is at the moment, we're expecting it to feed through to higher CPI rates of inflation because if wholesale prices are rising, eventually retail prices will be rising. Prices of these goods in the shops will then start to rise or feed through. So this is a very good future indicator of CPI inflation. And because this is significantly higher than our CPI at the moment, we're expecting further higher inflation rates. Hence the forecast that there is more inflation still to come. So a great figure to know, that one. Inflation is seeping into expectations, household expectations of 6%. No wonder wage growth is quite high and expected to go further. Again, a contributor to inflation. But like we said before, in real terms, wage growth is negative. It's lower than the CPI inflation rate. And food price inflation at the moment, 5.9%. That's the next one coming. That's going to bite. That's going to keep inflation up over the next few months as well. So look out for more. It's a very scary picture, is inflation. And now you know why. Let's talk about trade, shall we, next? Well, our current account deficit, stubbornly high, it always is, 3.7% of GDP. Our kind of decade-long average is 4% of GDP, one of the largest, most persistent current account deficits in the world, and a concern because of what drives it. Supply-side issues, lack of export competitiveness factors are driving our large current account deficit, in particular, very, very poor productivity ever since the financial crisis. Our labour productivity has been shockingly bad in the UK. A few stats for you. Compared to the G7, that is the 7 largest, most advanced countries in the world, our productivity in the UK is 20% below the average of the rest of the G7. Compared to the financial crisis, every year our productivity has only grown by something like 0.2%, which is shocking. And if we look back at our pre-financial crisis trend, if that trend had continued, then we are currently 25% below that pre-financial crisis trend, just to let you know how poor labour productivity is. And of course, that's going to mean cost of production higher for firms, which is going to mean our exports are more pricey compared to our trading partner countries, making our export competitiveness quite poor, driving our large current account deficit. But also business investment, very poor. It's been that way ever since we voted Brexit. Naturally, business confidence terrible after that vote, given the uncertainty. COVID hit, huge uncertainty for firms again. There was almost no investment taking place during the COVID years. Recently, we've seen green shoots of recovery, but now with the cost of living crisis we're going through, high rates of inflation and uncertainty again, business confidence is coming down. At the same time, contractionary policies like higher interest rates is not helping to fuel more investment. So again, this is driving our very, very high current account deficit. Our exchange rate, well, we saw after we voted Brexit, the pound crashing against the dollar and the euro. We've seen recovery in the pound since. So a few months ago, we saw £1 touching $1.40. But since then, the pound has weakened to the dollar, currently $1.26. That's more an indicator of how strong the dollar is as opposed to weakness in the pound. But against the euro recovery, when we voted Brexit to the euro, the pound fell to something like €1.07, €1.08. So to be at €1.19, decent recovery there. Minimum wage, another reason why our exports are not that price competitive. One of the highest minimum wage rates in the world at £9.50 per hour. We're expecting that to rise in future years. The Labour Party, can you believe, want that to be £15 an hour, which would make us wholly uncompetitive if they got that through. And what about economy in the US and in the Eurozone? Their performance, remember, that could be a big driver of UK export demand. Well, in the US, very, very strong rates of growth. In the Eurozone economy as well, high recovery in theory. That should help to spur higher demand for UK exports. So let's now, guys, shall we talk about government finances and interest rates to finish. Well, our government finances are in the worst position they've been since World War II. Starting with our budget deficit, that is annual government borrowing, we can see that in the fiscal year 2020 to 2021, that is the 1st of April 2020 to the 31st of March 2021, our budget deficit was 14.5% of GDP. That is £305 billion worth of borrowing in that one fiscal year. In the fiscal year just finished, 1st of April 2022 to the 31st of March this year, 2022, our budget deficit was still very high, 5.6% of GDP, over £100 billion worth of government borrowing in that fiscal year. To give you some context, the fiscal year prior to COVID, so 2019 to 2020, our budget deficit was only 2% of GDP, around £40 billion worth of borrowing. So this is extraordinarily bad on the government finances side, and it's why we're seeing such heavy contractionary fiscal policy right now to try and bring these figures down. The reason why these figures were so high, there was so much government borrowing, is because of the huge expansionary fiscal policy the government used during the heart of the COVID crisis. Huge increases in healthcare spending, not surprising. We were in a pandemic. We saw the furlough scheme, wage subsidies to the employed and the self-employed, a massive increase in government spending there and borrowing to fund it. We saw spending on welfare go up, and we saw a range of tax cuts too. All of this meant that we saw huge borrowing which lasted for a couple of years, that is for sure. That's all fed through to higher national debt as well. The total stock of debt that the government has is now 96% of GDP, and this is going to burden future generations for many years to come. We're already seeing the contractionary fiscal policy, the higher taxes that are being used now to try and run down all this debt and run down all of this borrowing. Even during the financial crisis years, the worst kind of budget deficit we saw was in 2010, 10% of GDP, our budget deficit back then. We've even beaten that. That's how deep this COVID crisis has been and how heavy the expansionary fiscal policy has been as well. And these figures are expected to stay quite high for the next few years. Yes, budget deficits hoping to come down a little bit. Yes, the national debt coming down a little bit, but really these are going to be stubbornly high for the next few years. A lot of burden on future generations. We look at bond yields, which represent essentially the cost of borrowing for the government. Bond yields have gone up to 2%, so it's now becoming more expensive for the government to service this debt. Forecast for this year is that servicing debt, paying interest on all of this government debt, is going to cost the government £86 billion. That's an extortionate sum. That's almost how much we spend yearly on education in this country. So carrying a huge opportunity cost now to service this debt at rising interest rates. We move to the tax side of government finances. Income tax bands, well, we have a progressive income tax system in the UK. So the first £12,570 worth of income is tax-free. That's the income tax-free allowance. From £12,570 to £50,270 worth of income is taxed at 20%. From £50,270 to £150,000 is 40% tax. And then anything greater than £150,000 is taxed at 45%. What's interesting though, is that these tax bands have been frozen up until April 2026. And that acts as a significant tax rise for workers, not explicitly, but by stealth, because what happens is incomes will rise at least in line with inflation, you would hope. But if these tax bands are not going to be adjusted in line with inflation, as people earn more simply in line with inflation, they could be dragged into higher tax bands and thus actually will be paying higher rates of tax. So in truth, they're actually going to be worse off because of a policy like this. That's a phenomenon known as fiscal drag. And this really is fiscal drag on steroids. It's a smart way for the government basically to earn more income tax revenue without directly increasing income tax. And some forecasters said by 2025, the government could be earning around £8 billion more in income tax revenue simply by freezing the bands. So that's one example of a contractionary fiscal policy for you there to try and deal with mountains of government debt. Even national insurance is going up. This is a tax on having a job. Employees pay it, but also employers have to pay it too. That is, firms have to pay this one too. That's going up by 1.25%. That's just happened. So another direct tax rise. And these are big ones, big direct tax rises. And even corporation tax is going up. 19% currently, but it's going to be 25% in 2023, but only for firms who are making more than £250,000 worth of profit are going to be paying that higher rate. We're still going to have the lowest corporation tax rate in the G7. The Chancellor in the UK has kind of taken a bite off some of these policies. For example, national insurance, the amount of income you earn before you pay a national insurance is going to go up, so it's going to be a wider amount of income you earn before you start paying it, which is going to help. And income tax, the 20% rate is going to be 19% in 2024. But still overall, these are big direct tax increases to deal with this COVID debt. VAT is currently 20%, and our Gini coefficient, good stat to know, 0.363, a figure that's risen from pre-COVID levels. Not surprising, because in a very deep recession, it's always those on low incomes, low skills, who tend to lose their jobs the quickest, and young workers who lose their jobs the quickest because they're very easy to re-employ and not a huge loss for firms given how lower skilled they are. So that tends to drive up inequality in a recession, which is what we've seen. Let's finish now by talking about interest rates in the UK. Well, we can see the Bank of England base rate is 0.75%. That's a figure that's increased 3 times since December. During the heart of the COVID crisis, interest rates were cut all the way down to 0.1%, record lows in the history of the Bank of England. They've raised it 3 times to 0.75. Why? To try and fight very higher than target rates of inflation in the UK. We know inflation is 7%. So that's the idea now, contractionary monetary policy, higher interest rates to target that. Is it going to work though? The answer is, well, no, because higher interest rates are targeting the demand side, and we know that actually a lot of the drivers of inflation are from the cost push side. So unless the Bank of England raise rates very, very quickly and at very high levels, we're not going to see that inflation rate come down. We are expecting this figure to rise further though, so make sure you stay up to date with it. It's going to be higher than this by the time you sit your macro exam. So very much contractionary monetary policy, higher interest rates, which are feeding through to lending rates for consumers, households, businesses, now at 1.75% higher than it was before. Are banks willing to lend still? Absolutely, they are generally good. What about consumer and business confidence? Are both of those willing to borrow? Well, we know consumer confidence has been high, but recently has fallen off a cliff edge, reasons we've said before. Same thing with business confidence, really. This cost of living crisis, uncertainty about UK macro performance is hitting confidence in both ways. What about our savings ratio? This is the proportion of disposable income that's saved. That's coming down dramatically, almost to pre-COVID levels at 6.5%. Not hugely surprising that it's coming down. Still, interest rates are quite low. And what about quantitative easing? Well, our total QE, total money that's been pumped into the UK economy, stands at £895 billion. We've used quantitative easing 3 times. Once during the financial crisis years, second after we voted Brexit in 2016, and more recently during the COVID pandemic. And during COVID times, the Bank of England pumped £450 billion worth of QE money into the economy. That is extraordinary. Around 25% of our GDP of money pumped into our economy is absolutely crazy to think about it. And that is half of the overall QE total. They were forced to, because we ran out of space with interest rates. We cut all the way to 0.1% as far as they could go. So we were forced to use heavy quantitative easing. So good to know those figures as well. And that, guys, is it. That's all of the key stats you need to know about the UK economy and UK macroeconomic performance. Really make sure you've taken all of that down. You've got the background too, and you can use these, sprinkle these in your macro essays to make you look incredible when you're writing those essays and hopefully to drive you to very high marks. Please make sure that you share this video with everybody that's going to find it helpful. And please make sure that you also watch all the other videos in my revision for 2022 exams playlist. There's so much in there that's great. That's going to help you do brilliantly in your final exam. So watch those videos as well. But thank you so much for watching this one, a very important video. I'll see you all in the next one. Thank you so much for watching.